There is something absolutely catastrophic and, really disastrous unfolding right now inside the electric vehicle industry. And the scary thing is when you look at Wall Street, when you look at the big financial news networks, they're completely blind to it. They aren't seeing it at all. We are looking at Tesla, a company that basically promised the whole world that they were going to revolutionize how we drive, that they were going to lead America's electric future. But they just discovered a fatal weakness. And this isn't a small crack in the foundation. This is a fatal flaw in their supply chain. And here is the thing that keeps me up at night. This vulnerability, it doesn't just have the power to cripple Tesla. It could take down every single electric vehicle manufacturer in the United States. Now, before you start guessing, no, I'm not talking about lithium batteries. I'm not talking about those rare earth magnets that everyone was panicking about last year. I am talking about something so much more basic, something so much more critical, and honestly, far more dangerous because nobody is paying attention to it. I'm talking about silver. Yeah, silver. The metal that nobody really thinks about. But it turns out this metal is absolutely essential to every single electric vehicle that is rolling off the production lines today. And here is the kicker, the part that should really worry you. China just demonstrated to the world that they can cut off America or us access to it whenever they choose to do so. Just like that. So stick with me here, because by the time we get to the end of this discussion, you are going to understand exactly why Tesla AS production targets for 2026 might actually be mathematically impossible. You are going to see why the entire electric vehicle industry in the US is basically built on geopolitical quicksand. And most importantly, we need to talk about what this means if you are holding Tesla stock right now, or if you are investing in EVs, or even if you are just betting on America's energy transition. Because what is happening right now, this isn't just some temporary hiccup in the supply chain. This is a structural crisis. It has been years in the making, and it is about to explode. Okay, let's get into the weeds a bit. First, I want to show you the numbers. These are the numbers that Tesla doesn't exactly advertise when they do their earnings calls. Every single vehicle that Tesla makes contains somewhere between 25 to 50 grams of silver. So, if you think in ounces, that is roughly 1 to 1.6 ounces of silver inside every single car. Now, I know what you're thinking right now. You're sitting there saying, well, 50 grams? That doesn't sound like much. It sounds tiny, right? But here's where the mathematics become absolutely devastating. You have to look at the scale. In 2024, Tesla produced 1.77 million vehicles. Then, through just the first 3 quarters of 2025, they have already manufactured over 1 million units. So, I want you to do the calculation with me. Let's just take a conservative estimate, okay? Let's say 35 grams per vehicle. Just with that conservative number, Tesla alone consumed approximately 43 to 88 million grams of silver last year. That translates to somewhere between 1.4 to 2.8 million troy ounces. And remember, that is just for one single company. But here is the detail that changes everything. The silver, it isn't just sitting in one big lump in the battery pack. It is woven throughout the entire electrical architecture of every single vehicle Tesla builds. Where exactly does it go? Well, it's in the electrical contacts, the connectors, it's in the circuit boards and the battery management system, it's in the power electronics, the inverters, the control modules, the wiring harnesses, the sensor arrays, it's in the high-performance switches. Basically, it is in every component where electrical efficiency determines whether your Tesla gets 300 miles of range or only 250 miles. And why silver? Why do they have to use silver? I'm not a financial advisor, and I want to be clear that this isn't financial advice, and I'm not affiliated with anyone I'm mentioning here. This is just educational analysis based on public info. But the physics are simple. They use it because silver has the highest electrical conductivity of any metal on Earth. In an electric vehicle, every single percentage point of efficiency translates directly into driving range. And range, that determines whether customers buy your car or buy your competitor's car. There is simply no substitute. You physically cannot build a competitive EV without silver. Let's compare this to the cars we are used to. A traditional internal combustion engine vehicle, a gas car, it uses maybe 15 to 28 grams of silver. A Tesla uses up to 50 grams. That is nearly double the silver content. Now, I want you to scale that across the entire industry. Global EV sales hit 17 million units in 2025. The automotive sector is now consuming approximately 90 to 94 million ounces of silver annually. And that number, it is projected to surge higher every single year. By 2027, electric vehicles are going to overtake internal combustion engines as the single largest source of automotive silver demand. By 2031, EVs will account for 59% of all silver used in the automotive sector. The demand curve is exponential. It's going straight up. But here is the nightmare scenario. This is the part that really scares me. Tesla's entire production model, every factory they have built, every supply contract they have signed, it is all based on one critical assumption. They are assuming that silver will always be available at scale, at stable prices, and from reliable sources. Well, I'm here to tell you that assumption just shattered. Let me tell you what they are not discussing on the financial news networks. When most people think about silver production, what do they picture? They picture mines in Mexico or Peru, right? Guys digging ore out of the ground. And yes, Mexico produces the most mined silver, about 24% of global output. China and Peru each produce around 13%. But mining the raw ore is only half the equation. What actually matters, what really counts, is the refining and the processing. This is where China has established complete dominance. China controls the processing infrastructure that transforms raw silver-bearing ore into the refined metal that manufacturers can actually use. Here is the critical detail that most analysts completely miss. About 70 to 75% of the world's silver doesn't come from primary silver mines. It comes as a byproduct of mining lead, zinc, and copper. And who is the world's largest producer and refiner of these base metals? It's China. This means that even if you have silver that is mined in Mexico or Peru or Australia, it often flows through Chinese smelting and refining infrastructure before it reaches the market in a usable form. Just think about the strategic implications of that for a second. China doesn't need to own the silver mines. They control the processing bottleneck. It is the exact same playbook they executed with rare earth elements. They don't mine all the rare earths in the world, but they control over 90% of the processing capacity. That gives them total leverage over the entire supply chain. And in 2025, they started weaponizing that leverage. Let's look at the timeline because it tells a story. On April 4th, 2025, China imposed export controls on 7 heavy rare earth elements. We're talking about samarium, gadolinium, terbium, and dysprosium. These materials are critical for EV motors and electronics. Companies trying to export these materials suddenly faced months-long delays, mountains of paperwork, and license denials for anything with potential military applications. Then, in October 2025, China escalated it. They expanded export controls to cover medium rare earths processing technologies and imposed even stricter end-user verification requirements. European automakers started shutting down production lines. Prices for terbium and dysprosium spiked 3 to 6 times in non-Chinese markets. The message was crystal clear. China can strangle supply chains whenever geopolitical interests demand it. Now, yes, after high-level negotiations between President Trump and Xi Jinping in South Korea, China agreed to suspend many of these restrictions. But, and this is a huge but, that suspension expires in November 2026. It is temporary. It is a geopolitical pause button. And every single supply chain manager in America understands what that means. The threat isn't gone, it's just on hold. And when it comes to silver refining, China holds the same structural advantage. They have built processing capacity that the rest of the world cannot quickly replicate. So let's examine Tesla's exposure to this Chinese supply chain choke point, because the numbers are far worse than most investors realize. Tesla's Shanghai Gigafactory isn't just another manufacturing plant. It is the most productive facility in Tesla's entire global network. Annual capacity exceeds 950,000 vehicles. Through December 2025, the Shanghai plant has produced over 4 million cumulative vehicles. It accounts for nearly 50% of Tesla's total global deliveries. That is half of every Tesla sold worldwide, rolling out of one factory in China. But the dependency goes deeper than just the building. Over 95% of components used in Shanghai-built Teslas come from approximately 400 Chinese suppliers. These aren't just minor parts, folks. This includes the battery cells from CATL, Contemporary Amperex Technology, the world's largest battery manufacturer. KTL supplies the lithium iron phosphate cells that power standard range Model 3 and Model Y vehicles. CATL also supplies critical cathode components to Tesla's Texas Gigafactory for their advanced 4680 battery production. Nearly 40% of Tesla's global EV battery material suppliers are Chinese companies. You have Ganfeng Lithium for lithium products. You have Zhejiang Huayu Cobalt for cobalt materials. You have Jiangsu Novare for inorganic compounds. These suppliers provide the integrated electrical systems that include the silver-intensive components we discussed, the connectors, the circuit boards, the power electronics. Everything that makes an electric vehicle actually function. Now, to be fair, Tesla recognizes this vulnerability. In 2025, they began requiring suppliers to eliminate China-made components from parts used in U.S. factories in Fremont and Austin. The target deadline is a full phase-out within 1 to 2 years, approximately by 2027. But here is the fundamental problem. You cannot simply replace an entire supply chain with a memo and a deadline. Alternative suppliers need to be identified. They need to be qualified. They need to be scaled to production volumes. New facilities need to be constructed. Quality standards must be maintained. All of this requires years and billions in capital investment. Meanwhile, Tesla's China operations remain completely dependent on the existing infrastructure. Any disruption, whether from renewed export controls, escalating trade tensions, or geopolitical conflict, would immediately impact the factory that produces half of Tesla's global vehicle output. In China, they have already demonstrated a willingness to use export controls as strategic weapons. The restrictions imposed in April and October 2025 were suspended, yes, but only until November 2026. The geopolitical sword of Damocles hangs directly over Tesla's most critical production facility. While Wall Street obsesses over Tesla's quarterly delivery numbers and Elon Musk's latest announcements, there is a much more serious story unfolding in the company's financial statements. Tesla's profit margins are collapsing. Third quarter 2025 total gross margin came in at 18%, down from 19.8% year over year. Automotive gross margin, excluding regulatory credits, dropped to approximately 14.7 to 15.4%. Operating margin crashed to 5.8%, down over 500 basis points year over year. Third quarter net profit fell to $1.4 billion, down 37% compared to the previous year. These are margins that look like traditional automakers, not the premium technology company Tesla has positioned itself as. The official explanation is price cuts. Tesla slashed prices throughout 2024 and 2025 to stimulate demand and compete with Chinese EV manufacturers like BYD. But there is another factor that doesn't get discussed enough: cost sensitivity to raw materials. Batteries account for 30 to 40% of Tesla's production cost, and the metals in those batteries experience extreme price volatility. For high nickel battery vehicles, like the long range and performance models, 60 to 70% of metal cost exposure comes from nickel, lithium, and copper. For lithium iron phosphate vehicles, like the standard range Model 3 and Model Y, 50 to 60% of metal cost exposure comes from lithium, copper, and graphite. A 30 to 50% spike in lithium or nickel prices translates to $2,000 to $5,000 additional cost per vehicle. In 2025, Tesla actually benefited from collapsing lithium prices due to oversupply. That helped cushion the margin pressure from their aggressive price cuts. But what happens when supply tightens again? What happens if China restricts exports of critical processing capacity? Tesla gets squeezed from both directions. They can't raise prices because of competition from BYD and others. They can't absorb cost increases because margins are already compressed. And they can't easily switch suppliers because the supply chain is optimized for specific sources. This is why the silver situation is so critical. Silver isn't Tesla's largest metal cost, but it is a non-negotiable component with no effective substitute. If supply gets constrained or prices spike due to geopolitical tensions, Tesla has zero flexibility to respond without destroying what is left of their profit margins. Let me show you how catastrophically exposed the United States actually is when it comes to critical metals needed for electric vehicles. According to the U.S. Geological Survey 2025 report, the United States is 100% net import reliant for 12 to 15 critical minerals. They are more than 50% reliant for an additional 28 to 29 minerals. And for many of these materials, China is the leading or dominant import source. For silver specifically, the U.S. has approximately 24 refineries that report commercial-grade silver production. Domestic mine production in 2024 totaled about 100 metric tons, or 35.4 million troy ounces. But here is the devastating reality. That is nowhere near enough for domestic demand. The U.S. automotive sector alone is projected to consume 90 to 94 million ounces of silver annually by 2031. Add in solar panels, electronics, AI data centers, and other industrial applications, and you're looking at a massive structural supply deficit. The real vulnerability isn't just mining capacity, it is processing infrastructure. U.S. silver refining capacity handles recycling and some primary production adequately, but the infrastructure for processing silver-bearing concentrates from base metal mining is limited. Compared to China's integrated smelting operations, we are way behind. When lead, zinc, and copper concentrates from around the world need to be processed into refined metal, much of that work flows through Chinese facilities. And it isn't just silver. Look at the broader critical minerals crisis. Rare earth elements. We are 80% net import reliant in 2024, with China dominating processing despite U.S. mining efforts. Graphite? The U.S. faces a projected negative 193% shortfall by 2035. Nickel? A projected negative 9,275% shortfall by 2035. These aren't rounding errors, folks. These are existential supply vulnerabilities. Recent stress tests show that under a Chinese export ban scenario, U.S. stockpiles of critical minerals could deplete within weeks. Alternative sources might recover only 10% of supply for certain materials, and this isn't theoretical speculation anymore. In 2025, China demonstrated exactly this. Rare earth export controls caused production halts at auto suppliers across Europe and the US. Dysprosium and terbium prices surged 3 to 6 times in non-Chinese markets. Manufacturing delays cascaded through multiple industries. The temporary suspension of restrictions in late 2025 provided relief, but remember, it expires in November 2026. Here is the bottom line that nobody in Washington wants to admit. The United States is attempting to build a domestic electric vehicle manufacturing industry on a foundation of imported critical materials. Most of those materials flow through Chinese processing infrastructure. Every single major EV manufacturer in America faces the same structural vulnerability. Tesla, Ford, GM, Rivian, they are all exposed. And when it comes to silver, the refining bottleneck means that even silver mined in friendly countries often requires Chinese processing capacity before it reaches manufacturers in usable form. This is an industrial strategy built on geopolitical quicksand. Now, let's examine what is actually happening in the physical silver market, because this is where supply chain vulnerabilities collide with market fundamentals to create a perfect storm. According to the Silver Institute's latest data from November 2025, the global silver market is heading for its 5th consecutive annual deficit. The 2025 projected deficit is approximately 95 million ounces. That means 95 million ounces more silver was consumed than was produced through mining and recycling. The cumulative deficit from 2021 through 2025 totals nearly 820 million ounces. Let me put that in perspective for you. 820 million ounces of silver vanished from above-ground inventories over 5 years. That is roughly equivalent to one entire year of global mine production. Where did it go? Into solar panels that can't be recycled, into electronic devices buried in landfills, into industrial applications where the silver is effectively consumed and not recovered. Supply-side numbers tell a concerning story. Total mined silver production in 2025 came in at approximately 835 million ounces. That is essentially flat compared to recent years. Mine production has actually declined 7% since 2016, despite silver prices rallying significantly. New mine production isn't coming online fast enough to close the gap. Recycled silver reached 195 million ounces in 2025, a 13-year high. But even at record recycling rates, secondary supply can't offset stagnant primary production. Total physical supply for 2025 is approximately 1.05 billion ounces. Demand-side numbers reveal the structural problem. Total global demand for 2025 is projected at 1.2 billion ounces. Industrial demand accounts for approximately 665 million ounces, roughly 59% of total demand. Solar photovoltaics alone consume 230 to 260 million ounces. The automotive sector, driven by EV production, uses 90 to 94 million ounces annually. The mathematics is straightforward. Demand exceeds supply by roughly 100 million ounces every single year. This deficit is occurring while Tesla ramps production, while global EV adoption accelerates, while solar installations hit record levels. Now, here is what makes this crisis fundamentally different from other commodity shortages. Remember, 70 to 75% of silver comes as a byproduct of lead, zinc, and copper mining. This means silver supply doesn't respond to price signals the way primary commodities do. When copper demand drops, silver supply also drops. Even if silver prices are soaring, production is tied to completely different market dynamics. This creates structural supply rigidity that cannot quickly adjust to surging industrial demand. During 2025, silver prices surged to multi-year highs, briefly touching $64 per ounce in mid-December. Many analysts now forecast silver reaching $100 per ounce by late 2026 or 2027, based purely on supply-demand fundamentals. And that is before factoring in any geopolitical disruptions. These deficit numbers I just shared are the baseline. They assume normal trade flows, stable geopolitical conditions, and no major supply shocks. If China decides to restrict silver refining capacity, if export controls on rare earths disrupt EV production, if trade conflicts escalate, you're looking at a supply crisis that makes the current deficit look manageable. The physical silver market is already operating on razor-thin margins. One significant disruption could break it completely. So let's connect all these threads and talk about what this actually means for investors, for Tesla shareholders, and for anyone betting on America's electric vehicle future. Tesla can't get silver, not because silver doesn't exist, but because Tesla cannot guarantee secure, uninterrupted access to the refined silver and critical materials needed to maintain their ambitious production targets. China's export controls, even though temporarily suspended until November 2026, exposed a fundamental vulnerability in the entire U.S. electric vehicle manufacturing ecosystem. This crisis is bigger than one metal. Bigger than one company, bigger than one industry. What we are witnessing is the collision of three unstoppable forces. First, the global energy transition is creating unprecedented industrial demand for silver, rare earth elements, and dozens of other critical materials. Second, the supply chains for these materials run directly through China, which has demonstrated clear willingness to weaponize them for geopolitical leverage. Third, the United States has virtually no ability to replace these supply chains in the short to medium term. Tesla's de-risking efforts, their attempt to eliminate Chinese components from vehicles built in American factories, won't reach completion until 2027 at the earliest, and that assumes no additional disruptions, no escalation of trade tensions, no further export restrictions. Meanwhile, the physical silver market is already running a 95 million ounce annual deficit. EV production is scaling faster than silver supply can grow, and the temporary suspension of Chinese export controls expires in November 2026, less than 12 months away. For investors, this creates several critical implications you need to understand. First, physical silver demand from industrial applications is structural and non-negotiable. Unlike investment demand, which can evaporate during bear markets, industrial users need silver to manufacture products. They will pay higher prices rather than halt production lines. Second, companies with heavy exposure to Chinese supply chains, particularly in EVs and electronics, face significant execution risk that equity analysts are systematically underpricing. Third, strategic metals like silver, copper, and rare earth elements are transitioning from commodities to geopolitical assets. The title of this video was deliberate and accurate. China's export restrictions didn't just threaten Tesla. They exposed that American high-tech manufacturing, particularly electric vehicles, is built on a supply chain foundation controlled by a strategic rival. That is not a sustainable position. It isn't a secure position. And it is about to force a complete restructuring of global manufacturing and supply chains. The question facing investors and policymakers isn't whether this crisis will unfold. The question is how severe it becomes before alternative supply chains can be built. And right now, that timeline stretches years into the future. While the deficits are happening today, while geopolitical tensions are escalating, and while the clock is ticking toward November 2026, when China's temporary export control suspension expires. If you found this analysis valuable, I need you to do three things right now. First, hit that subscribe button and turn on notifications. We are tracking the silver supply crisis closely, and there will be major developments throughout 2026 as trade agreements expire and the physical market continues tightening. You need to be informed before these stories hit mainstream financial media. Second, leave a comment below. Tell me, do you think Tesla can successfully de-risk their supply chain before the next crisis hits? Or are we looking at production shortfalls and margin compression in 2026 and 2027? I read every comment, and your insights help shape future coverage. Third, share this video with anyone invested in Tesla, anyone holding EV stocks, anyone betting on the energy transition. Most investors have absolutely no idea how vulnerable the electric vehicle supply chain actually is. The financial media isn't covering this angle because it contradicts the clean energy narrative they are promoting. We cover the stories that actually matter for your financial future. The geopolitical risks Wall Street ignores. The supply chain vulnerabilities that don't appear in earnings reports. Structural forces that determine which companies survive the next decade and which don't. Because while everyone else obsesses over quarterly delivery numbers and stock price movements, we are tracking the fundamentals that will define the next 5 years of the EV industry. This is War and Mystery Chronicles, bringing you the analysis the mainstream won't. We'll see you in the next one.